You remain long and strong. What do you make of the early action so far this year? And what's your take on what is still a long way to go in 2022?
Well, we'd have to say, Brian, that when we look at the landscape, what we just saw happen over the course of the last few days, last week into yesterday, was very much standard for this kind of an environment where you've got the Fed getting ready to really, in earnest, address the inflation issues. It's a pivotal move that the Fed chair has been making, and really since the end of the fourth quarter of last year in terms of the message. And naturally, you get volatility. But I think Jamie Dimon just said it in that sequence you had just before I came on. Yeah, the economy is doing well, and we look at the fundamentals, and the fundamentals are highly supportive for equities right now. In our case, we look for interest rates to rise, but relatively modestly, as the Fed remains very sensitive to economic growth and employment, and considers the role of business in digesting higher rates. So we think the environment remains good for equities.
Okay, I hear you. And in '94, I think we had the equivalent of 10 rate hikes. They raised rates 2.5%, and the market surged in '95. So stocks can historically show they can go up in a major raising rate environment. However, John, I do worry. We've never had a Fed balance sheet like this, $8+ trillion. Many people I read and talk to say they're more worried about the negative effects of the reduction of the Fed balance sheet than they are about raising rates.
I can understand that concern, Brian, but when I look at it, I can't help but think, what if they hadn't taken on all that onto their balance sheet? Where would we be today? Would we be at a good enough level to move and cross the next platform, essentially, or the next traverse, to get to the next new normal? And I think as a result of that, we have to accept what was done and consider, what if they hadn't? And from that perspective, parallel to what happened in the financial crisis, coming out of that, move ahead. We can't help but think, when you mentioned '94, just happened this morning, I looked at it, the S&P 500 in '94 was down 1.54%. Tech was up 19%, consumer staples 6.8%, materials 3.32%, real estate flat, energy was down 0.4%. I'm not going to go through everything, but the worst performers were consumer discretionary down 9.88%, and the Utes down 17%. So the funny thing is, tech, which got hit hardest yesterday, happened to be, and when we look at it, and others have looked at it as well, it's the most resilient because it's deeply embedded, more so than ever before, in the lives of business and individuals.
I don't know if I'm more impressed by the data or the fact that you were up early enough even before this to do that kind of work when the show starts at 5 a.m. I don't even want to know. John, you're a better man than I am. So does that mean that this year, based on your projections, we should still selectively own tech and still maybe, like '94, sell things that are rate sensitive, like utilities?
Yeah, I would think so. I wouldn't sell all my exposure to the Utes because I want some income in terms of income, and I also want to have a diversification. But in terms of technology, and in this case, consumer discretionary, because people are hungry to get back to a more normal spending environment, and we could see that with just the increase in debt that the consumer took on over the last month or so. So we've got to say we want to own consumer discretionary, technology, industrials, financials as our favorites, and then continue with materials and energy exposure as inflation remains an issue. And you know that's going to continue for a while. But we're positive on equities.